Welcome to This Explainer. Today, we're putting on our expert analyst hats to unpack British American Tobacco's 2026 corporate earnings update. Now, if you follow the markets at all, you already know traditional tobacco is facing a massive structural decline. So the big question for us investors today is this: is BAT just a classic value trap, or are we looking at a textbook Peter Lynch-style turnaround play? Let's dive right in and analyze this corporate transition in real time. Let's kick things off with a number that honestly stopped me in my tracks: 18.2%. As of their latest reporting for 2025, 18.2% of British American Tobacco's entire group revenue is now completely smokeless. This actually represents a 70 basis point increase versus the prior year. And look, that is a critical margin expansion that matters immensely when you're evaluating a turnaround. For a company historically synonymous with traditional combustible cigarettes, crossing that 18% threshold is huge. It signals that this massive corporate transformation is gaining serious, tangible momentum. To make sense of this transition, our explainer is going to hit 4 key areas. 1. The smokeless pivot. 2. The 2026 financial outlook. 3. The market headwinds. And 4. Shareholder returns.
All right, jump in right into Section 1, the smokeless pivot. Let's see how they're shifting the core business.
Look at the sheer momentum of their new category brands here. We're forecasting mid-teens revenue growth for the first half and the full year of 2026. If you're thinking like Warren Buffett, this is essentially management aggressively trying to dig a brand new economic moat. Led by Velo in modern oral and Vuse in vapor, they've added an impressive 4.7 million consumers, which brings their total base to over 34 million. They aren't just sitting back and reacting to regulation. They are taking a very front-footed approach to actively shape a smokeless future. Now here is a fact that might actually make you do a double take. Despite being a legacy tobacco company, BAT has maintained an A ESG rating from MSCI. I know it almost sounds like an oxymoron, but this rating directly reflects their aggressive push toward reduced-risk products, as well as strict sustainability and circularity goals. It is a vital checkbox for institutional investors, who might otherwise just automatically screen the whole sector out. Moving on to Section 2, the 2026 financial outlook. Let's look inside the engine room. Before we start projecting the future, here is the bottom line up front. We're looking at a trailing earnings per share of 349.10 pence. Pair that with a pretty modest PE ratio of roughly 13.19. If you are a Benjamin Graham disciple, your ears probably just perked up, because we might be looking at a very real margin of safety here. The market is basically pricing this as a mature, cash cow value stock, even as it attempts this high-growth pivot in its new categories. So BAT has reaffirmed its medium-term growth algorithms. That's 3 to 5% for revenue, 4 to 6% for adjusted profit, and 5 to 8% for adjusted diluted EPS. However, and this is key, management is transparently guiding 2026 expectations to the lower end of these ranges. Buffett always emphasizes the importance of honest management, and this kind of transparency is a massive plus. They are openly acknowledging some short-term turbulence and investing heavily for a second-half recovery, specifically an innovation-led push in their Glow heated tobacco line.
Okay, Section 3, market headwinds. Let's balance the equation.
This contrast beautifully visualizes the tension at the very heart of BAT's current business model. It's a total tug-of-war. On one side, you've got powerful tailwinds, aggressive mid-teens revenue growth in new categories, highly successful U.S. momentum, and a massive operating cash flow conversion rate of over 95%. But they're actively fighting some really stubborn headwinds. Global cigarette volumes are in a structural decline of around 2%. They're also dealing with a slower recovery in the Asia-Pacific and Middle East regions, plus a roughly 3% translational foreign exchange hit on adjusted EPS. It is a constant battle between their smokeless future and their combustible past.
Finally, Section 4, shareholder returns, the payoff.
Let's see how all this translates into capital allocation. They have committed a massive £1.3 billion to a share buyback program in 2026 alone. This is exactly what we want to see. By reducing the outstanding share count, they are organically boosting earnings per share and driving total shareholder yield. It absolutely proves they generate enough surplus cash to sustainably reward investors, even right in the middle of a really costly transition. But they aren't just throwing cash around. They are maintaining strict balance sheet discipline. This is a crucial checkmark on any defensive investor's checklist. That 95% operating cash flow conversion, that is the secret sauce. It funds the buybacks while keeping leverage targeted at a very manageable 2.0 to 2.5 times adjusted net debt to adjusted EBITDA by year-end 2026. And the credit markets totally agree, maintaining stable investment-grade ratings across S&P, Moody's, and Fitch. They are literally fortifying the foundation while completely remodeling the house. For those of you laser-focused on yield, here is the exact payout schedule. The board declared a dividend of 245.04 pence per ordinary share for the year, split evenly into 4 installments of 61.26 pence. Starting in May 2026 and wrapping up in February 2027, it's a progressive, highly structured return of capital. It's perfectly designed to reward investors for their patience during this multi-year pivot.
Which brings us to the ultimate million-dollar question based on the data we've explored today. Can this mid-teens growth in new categories actually continuously offset the 2% structural decline of their legacy cigarette volumes? BAT is proving they have the cash flow, the brand momentum, and the absolute discipline to manage this transition. But will that smokeless engine accelerate fast enough for long enough to outrun the decline of their legacy business? That is the definitive metric you need to be watching. Thank you so much for joining me for this explainer, and remember, always keep your eyes on the data.